Hi, I'm Caleb from Caleb and Carol Real Estate. We help our clients make the best decision when it comes to housing needs, be it selling, buying, or investing in properties. So in today's video, we're going to share with you whether should you clear your housing loan faster than your actual loan tenure. So if let's say your loan tenure is 25 years, should you clear it in 5 years, 10 years, or compared to the full 25 years, so that you know that at the end of the time whether to clear your loan faster than you wanted, than you've originally planned. So stay tuned to the end, where I will also share with you what I will do personally for myself, so that you can have a good idea and solution as well. Comment below right now if what kind of plans you guys are thinking of, whether to pay down your housing loan fast or whether you guys are planning to do it slowly within the 25 years period. Okay, so one of the scenario recently that I've seen recently is when Jane and John recently bought a house for 450,000. So they took a loan of about 400,000 for the house. The other 50k they paid by cash. Now they are thinking of paying this loan at the third year with their remainder CPF OA of 400,000. Should they do it? That's the question. So should they do it? Frankly speaking, I wouldn't suggest them to do it lah. So but let's look at the comparison. Why not? So if they were to pay off their loan will be zero already, and then there will be no interest on the loan. Means that their CPF OA will be zero as well, because they have used high amount to pay from their property. So technically speaking, this kind of give them a peace of mind, but frankly speaking, it really doesn't help in a sense, because you still need to pay back accrued interest back to your own CPF as well. So that is about 2.5%. 2.5% of 400,000 will be $10,000. Let's look on the other side. If they don't pay off the loan, it will still be $400,000, and then the interest on the loan that it's 1.5%. But because you have money inside their CPF OA of 400,000, the interest generated from that is 2.5%, which means to say that they earn $10,000. At the end of the year, they would have earned $10,000, and they would have spent $6,000 in terms of interest, leaving them $4,000 in earned interest. So at the end of the day, if you see that the interest provided by CPF is higher than the interest charged by the bank, it's better not to pay off your loan. But if it's the other way around, I would suggest you to pay off your loan. So there is a loss in opportunity cost when we talk about paying off your loan first with CPF OA compared to not paying off your loan, because you get to earn $4,000 extra in interest. So next, what happens when in 5 to 10 years time, when they decide to sell, when you decide to sell, or when Jane and John decide to sell? So if you decide to sell 5 years later, if you don't pay off your loan, you will have used up 95,000 worth of CPF, because 1 month installment is about 1,600 times 60 months, there will be 95,000 worth of CPF, which will compound in terms of interest. Because of accrued interest, you still need to pay back to your own CPF of 102,000. So that therefore the 400,000, the outstanding loan, will be somewhere about 331,000, because some parts of it is paid as interest to the bank. So the amount that you still owe to the bank is 331,000. So to break even, you need to sell at least $433,000 to break even. Okay, so but whereas for people who is pay off their loan, so you pay off 400k already, but you'll still compound at 2.5%, so eventually pay back 452,563. What this means is that for you to break even, you still need to sell at 452,563, which is a lot higher than this, because over at not paying off the loan itself, what you are generating is additional interest from your CPF. But this one, you are fully paying the CPF on your own pocket. Instead of the government giving you money, now you are paying back to your own CPF already. So if 10 years later you have used up about 191,000 in your CPF, which means to say it compounds again to 217,000, which means to say that your right now your outstanding loan is 257. Then for you to break even on your property is $475,000. But what if you have paid off your loan? If you have paid off your loan, your 400,000 will have compound all the way to 512,000, and your 512,000, that's your break-even point. What do I really mean by break-even is whereby you don't get back a single cent at the end of the transaction. So if you don't get back any single cent, generally this will be the break even. So you notice that if you don't pay off your loan, the amount that you need to break even is a lot lower than if you pay off your loan, because of accrued interest again. Because on this 2.5% of accrued interest of 400,000, it's a lot bigger than whatever you have used over here. So question is that what if you can only sell at 400,000, which is the price that you pay? After 5 years, you only can sell at 400,000, you will have lost $52,000 already, because your CPF will have compound to 452, which means to say you have made a loss in your CPF of 52,000. And what if 10 years later? 10 years later, you would have also lost 112,000 if you sell at $400,000. So frankly speaking, if you were to pay off your loan early, it's not going to help you. It's going to harm you more than it helps you actually. So what would I have done actually? So this is the part that you guys have been waiting for as well. So most people want to clear off their housing loan because it gives them a peace of mind. So what I do is that I will save up at least 12 months worth of installment in cash, so that I will have peace of mind. If I'm in retrench, I have money to pay off my monthly installment if I really need to. What I'll also do is that I'll pay the interest of the monthly installment in cash, whereas the principal I'll pay back in CPF. Because what happens is that if I pay the interest in cash, right, this is an expense that is gone. I don't want it to compound with the 2.5% OA accrued interest, but I don't mind paying the principal because this is the amount that I'll be getting back when I sell my property. Okay, I don't mind this compounding at 2.5%, it's okay. But another thing is that I also want to save up and invest in other asset class, so that I can take advantage of my cash and my CPF to grow faster than this 1.5% interest rate. So I will definitely not pay off my loan, but I will utilize whatever excess fund that I have to invest in other assets that it grows faster than 1.5%, such that it makes it worthwhile for me to take this loan also. So if you find this helpful, please remember to help me click the like button or to click the subscribe button with the notification bell. It really helps a lot in the YouTube algorithm, and I hope to see you again soon. Goodbye.